Welcome to Swimming with Allocators. I'm Ernest Sweat, and each episode, Alexa Benz and I give you a VC podcast from the LP perspective. You ready? Let's dive in. On today's episode of Swimming with Allocators, our guest is Sam Sadowsky, a partner at 1200 VC, which is an early stage investment platform that invests in both fund managers and founders. This was a great conversation today where I really feel that Sam really incorporated all the different hats he's worn as an LP, GP, and former founder.
He gave us great advice for LPs on some of the differences and opportunities if you're doing fund level investments as well as direct investments, and some cool lessons learned from his early days investing in Climate 1.0 to now 2.0.
Today on Swimming with Allocators, we have the pleasure of speaking with Sam Sadowsky. He's a partner at 1200 VC, which is an early stage investment platform investing in fund managers and founders building companies shaping the future of humanity. The long-term vision of 1200 is to be a systematic value creator by becoming a leader at partnering with the seed stage towards regional, global, and planetary impact. Wow, that's a huge mission. Sam, thanks for joining us on Swimming with Allocators.
Oh, it's a pleasure to be here, guys.
So first, I wanted to start off with your journey into this asset class. Sam, your background is intriguing. It has a combination of operational experience, digital marketing, and a deep understanding of the capital markets. How did this unique mix lead you to the world of venture capital, specifically with both direct and fund investments?
Yeah, it's interesting. I kind of had an untraditional foray into the world of VC. I mean, in college, I got really into self-educating myself on capital markets, in addition to private markets as well. And I was fortunate enough that I had friends and family that were quite active in predominantly VC, some PE, but mostly VC. And I just spent a lot of time having a curious mind and wanting to learn more about, what are you looking at? Like, what's the near frontier now? At that time, it was Climate 1.0. There was a lot of bio. And I basically wanted to just absorb as much knowledge as I could. Then, I wore a bunch of hats and just career path, from working in the family business to leading digital marketing at a big PE-backed firm, to being a founder, which was a whole different peek into another world in and of itself. I really got to understand and see how the VC played a role in not only enabling us, but also helping us with decision-making processes, whether beneficial or detrimental. And as that started to wind down, I got a call from who's now my founding partner, Esteban, and he had this grandiose vision to build a standalone firm, and asked me if I would stop what I'm doing and come join this journey with him and help co-build this alongside him. And within 1 hour, I made up my mind, and I was like, this is what I want to do. This is what I want to dedicate the rest of my life to. And that's how that happened.
We see a lot of founders just think, oh yeah, I should head to the other side at some point and look to put on the investor hat. What's the parallel with doing direct investments and running a fund of funds?
So the way I kind of view it is that you're both, at the end of the day, underwriting for financials. You're also underwriting for human beings. And at the end of the day, this is like a human-based business. I view this as a we, us business, not a I, you business. And the interesting thing about investors that have worn the operator hat is I don't know if empathy is the right word, but there's a lot more understanding, like the trials and tribulations of a founder and what they have to go through, past learnings, any type of transferable knowledge set to help avoid past mistakes, get other perspectives. I think as an investor, you're just better suited to empathize, understand, and work directly with founders on core business problems than if you've only been in the allocator hat and only cut checks.
Sam, I had a quick question, Alexa. So Sam, we've heard a lot of just people, GPs who have that operator experience. And that's right in line in what you said about the empathy or just understanding that experience. But you rarely hear about allocators on the kind of LP investing in funds having that perspective. What advantage do you think that gives you when underwriting a fund manager?
When underwriting a fund manager, it just augments your ability to understand kind of how, you hear the word value add tossed around a lot in our industry. And there's, it's a very broad spectrum, but I think at the earliest stages of investing, the most concrete form of that value add kind of occurs in operator to operator, especially at the pre-seed. That's going to be the toughest time for people to solve for things. I mean, if you're a pre-seed founder, you're wearing whatever hat needs to be worn at any given time. If you're not an engineer, you're going to be working with your engineers. You may be left, but no matter how you slice it, you got to wear every hat. And I think it's nice to have people on your cap table that have either been through that or can empathize with that and are not going to tell you how to do your job, but just be I don't know if safe space is the right term, but a space where you can really just ideate, bounce ideas off each other, roll up your sleeves if they have a problem that is difficult to solve internally right now, and be that support system.
We've got a question on how you think about monopolistic outcomes.
Yeah.
So I think it's relatively easy for me to sort of understand what that looks like when you're doing the direct company startup investments. Does that also come into play in selection of managers? Yeah,
I think when you're looking at emerging managers, they should be taking firm building approaches to building, and look, you get a lot of people that want to scale and run the AUM game like really quickly. And I think that a lot of emerging managers outperform at their sweet spot of fund size. Could be 25, it could be 50, it could be 75. But their goal is trying to build a category leader firm, whether they're hyper specialized or generalist, they're taking the same path as a founder to capture as much market share and grow their firm to be a tier one partner, the same way a founder is growing their business to be a category leader and in their field.
Yeah. So that, fewer investments, more conviction, and really swinging for the fences.
100%. And I mean, when I speak to GPs, oftentimes I really like to dig into their vision for their firm and how they're going to scale their firm over time. And these things are one thing now, and then there's something else later in the future. And I think the ability to see that vision through speaks volumes to where their head's at as an entrepreneur themselves.
Yeah. I guess if you can get like 1.6x with T-bills right now, like
yes, you really got
your managers need to offer some. Yeah.
On differentiation, where do you come out on emerging managers' product offering of being more of a generalist versus a specialist? And specialization can come out a lot of different ways. Talking to a number of allocators on this podcast and just, in private conversations, there's very different views on which style they really think outperforms.
For sure. I think there's a place for both generalist and specialist managers. There's always going to be. I think different technological environments in terms of the innovation curve could prove advantageous both ways for the generalist that has more flexibility to really just capitalize on opportunistic opportunities, as well as specialists that are so dedicated to certain verticals that they have just unparalleled knowledge in that they can do highly technical diligence where a generalist firm may have trouble conducting that type of diligence, or they're going to outsource that diligence and not have the core understanding of it. I'm big on personally on specialist VCs for certain types of technologies. I think for really high technical hurdles, you need people that are specialized to even understand these businesses, because a lot of people think they're backing something between the space of improbable and impossible, where the domain expert knows that it's more probable than improbable should the science de-risk.
1200 has you've been in market for a bit. Has your perspective changed since getting started? Any lessons learned since you all opened shop?
I don't think our perspectives have changed. I think you need to have a degree of sensibilities around everything going on, both venture landscape, both macro. But the underlying theme is that good businesses are built in any environment. Great GPs and great firms are built in any environment. There isn't a single time where opportunity is not going to be plentiful. You may have to turn over more stones to find it. But that being said, the traditional path of knowing what makes good businesses, knowing what makes strong founders, completely ignoring whatever is going on in the macro, always is going to hold true. There hasn't been a single time in history where that's been not the case. You look at 08 and you look at the draft class of companies that came out of 08, 09, 2010, excellent companies. You saw this thing in the early 2000s, late 90s as well, when the VC market was way more nascent than it is today. But I think, yeah, you have to be cognizant. You always got to be learning. You're going to see things. You're going to see thematic shifts in where capital flows are going to. I don't think that you should absorb yourself in chasing what the hottest thing at the moment is. There's a place to be cognizant of it and to deploy into those sectors, but I don't think the chasing strategy is beneficial. I think removing the noise and understanding what you're good at, remembering how you were trained to understand businesses, how to underwrite businesses, is always going to be where the real value can be extracted out of your strategy.
Are there any untrendy categories that you see opportunity that maybe there aren't as many dollars?
Yeah, what's funny is that the narrative may differ from the actual capital flows, but if you look at things like construction tech, which are I think are great verticals personally, like capital has stayed quite consistent even in this year across those verticals. It's not as the narrative for it is not as sexy as something like AI or something like genomics or something like, that's something more frontier. But nonetheless, it has extremely high utility. The people that want to be deploying into that space know there's extremely high utility. Construction is not going anywhere. It's just going to get more and more efficient over time. And I think some of the non-narrative sexy industries are really going to be built to last and are going to see a lot of steady capital flow into them.
And you started out in climate 1.0 investing. Now that is the sort of one of the trendiest topics. Anything where you've learned that lesson, or any stories from 1.0 that could be valuable in 2.0?
For sure. I mean, I think that anytime there's something that's like very, very frontier and breakthrough, you're going to have adoption risk. And people discount adoption risk. There's a lot of variables that go into this, which is just existing practices, viability of the actual tech, switching costs. Does it cost me more money to actually deploy this over time? Will I actually save money? What are my intrinsic motivations to adopt this? Is it image-based adoption? Like, I feel like I need to do this to have my image basically augmented in our favor, or is it actually going to be beneficial to the business? And I think oftentimes nascent technologies, they need a bit to play out. I mean, I look at climate 1.0 and it's like your two biggest winners are Tesla and First Solar. And then there was just a whole swath of companies that, while they had viable technologies, they maybe weren't as viable as the story that was being sold. Even though the technical de-risking occurred, it occurred maybe too late. And I think there's been a lot of learning since then. And obviously technology doesn't move linearly. So just on a tech basis, there's a lot easier ways to deploy these things, de-risk them, pilot them quicker. Faster times to pilots help a lot. I mean, back then you would have like 6 years before you could get to a pilot for some of these things. And When that type of CapEx gets too high, VCs stop funding it. And I think now you can have less CapEx and you can get things to market a lot quicker, de-risk things a lot quicker. So the ability to trial and error is just drastically increased in terms of speed and efficiency.
Now we're going to take a quick break to speak with our sponsor. On the show today, we have an industry expert and sponsor, Rachel Waddell, Vice President of Investor Coverage at Silicon Valley Bank, a division of First Citizens Bank. Thank you, Rachel, for partnering with us on the show and being on the show today. So, Rachel, continuing on the great research that you all put out, SVB publishes a great report on the state of markets for the innovation economy. What does your data show for unicorns and the future of them?
Yeah, so, despite there are a few notable collapses this year, unicorns are generally well positioned to weather this storm, since a lot of these companies loaded up on capital in 2021 and 2022 and have really since cut costs and are prioritizing profitability. And when our data team last looked at the data in August, about 80% of these companies had 2 or more years of runway at their current burn rate. So they're definitely positioned to weather through this storm. But it's important to note that while, few unicorns are failing, there are really few that are being formed. We saw only about 25 established in the first 3 quarters of this year, compared to nearly 170 in 2022. Wow.
That is fascinating.
Mm-hmm.
And says a lot about the market. So, we're in this game as VCs to not just have unicorns and, retweet articles about our companies becoming unicorns. We want to get that moment of an exit. And so there are typically 2 options, IPO or M&A, right? Acquisitions. Let's first start. What do we see for IPOs in the near future?
Yeah, there was, I think, definitely the beginning of this year an optimism that the IPO window would fully reopen, maybe in the second half of this year. But, we kind of ultimately saw that fall a little short with few VC-backed companies completing a listing. And actually a large reason for this is the poor performance of many tech companies that went public in 2021, whose valuations are averaging about 50% of their IPO price. So that's really contributing kind of the drop in valuations for later stage companies and preventing a lot of them from wanting to exit. And then also just in conversations with some growth investors and late stage investors, we're really hearing that their expectation for the IPO market to reopen is now looking like the second half of 2024, even Q1 of 2025.
Yeah. And what about M&A activity?
Yeah, so to no surprise, it's definitely a buyer's market as runway kind of declines for these companies struggle to raise. Many are forced into a soft landing, such as an M&A, or will face bankruptcy and liquidation. So expectation that we'll see an increase in M&A activity and continue to see that. And SV actually has an internal index that's tracking troubled companies with less than 12 months of runway, high cash burn, low growth. And numbers have surpassed pre-boom time levels. So this can serve as an indicator that we'll see an increase in M&A activity in the coming months.
Rachel, you're such a good partner here in the venture ecosystem. For folks who are interested in getting in touch with Rachel and SVB, feel free to email her at rwaddell, Waddell, at svb.com. And now back to our LP interview. Shifting gears to your model, a large audience that listens to our pod are allocators, both experienced as well as those interested in allocating into this asset class. Could you speak to, first of all, like the decision to have a hybrid model of both direct and fund? And then have some follow-up questions on that.
Yeah, for sure. Generally speaking, I guess fund of funds typically, like pure play fund of funds typically didn't get the sexiest rap, from people. It's a very broad-based way to index an asset class. And when you look at the performance data, it performs in line with what you'd expect of the indexes. People are going to VC funds to outperform the index. And I think when you marry diversified portfolio, which you could argue is a risk mitigator, and you marry that with asymmetric upside of direct investing, you just get a more appealing product, and a product that's math is more favorable to what the average LP is looking for. You can oftentimes invest in things and try and cherry pick certain co-invest opportunities, but then you get stuck in the adverse selection conundrum. What if I'm only picking dogs in the co-invest side, and I think it's easier to have a blended vehicle of sorts than to try and basically make your own quasi-direct portfolio by cherry picking the co-invests that you want out of fund commitments. You also see opportunity funds come out of direct VCs, and that's like a similar, it's a similar way. It's obviously not blended. The other thing though with that is that sometimes I ask myself, is a pre-seed VC going to be able to execute an opportunity fund strategy at the A, B, and even potentially C stage? So I think being able to just bundle what you're good at, you get the asymmetry on the direct side, can be a lot more appealing to LPs that want a diverse exposure to an asset class.
That's a huge differentiator from what I've seen mostly, especially with fund of funds. Having a direct investment is mostly just co-investment. Mm-hmm. Like they limit themselves just to whatever their fund managers have invested in. Mm-hmm. And so this blended approach, what do you feel that your team and expertise has? I can assume what it is, but what do you think that allocators who do choose to have more of this blended approach, what's the type of expertise they need to have in-house to be able to do that successfully?
Yeah, I mean, also on that note, generally speaking, you need to be able to re-underwrite these deals for wherever that entry is, and understand that where you're investing now is you investing directly. It's not exposure on a fund level, through the look-through at the earliest stages. You have to be able to have sensibilities around, if I'm entering here at the A, this is going to be my cost base, or I'm entering here at the B, this is going to be my cost basis. Can I underwrite this for the outcomes that work for whatever your strategy may be when doing so? And the addition is that the asymmetry on the information side you get from being an LP in general into funds can really help you make informed decision making when you decide to go directs, especially if you're investing in something from a look through you may be invested in. I see a lot of LPs that will get co-invest opportunities. They'll take the memo that gets circulated to them. They'll make a decision off of that. I think the real way to be doing it is you as an LP, whether you're in an individual, an institutional allocator, you need to be actively managing for that portfolio. Obviously, venture is a lagging indicator, but you're in this privileged position where you're getting so much asymmetric information and being able to track these businesses from the inside that you should be building that conviction over that 12 to 18 to 24 month runway window prior to these subsequent financing, so that when you decide to evaluate that, you've had the past 12 to 24 months to really build that conviction independently of whatever conviction the manager you may be an LP into is building. And I think that's an important differentiator, is just generally when wearing an LP hat, is if you're going to go direct, build your own conviction. Do not rely on the GPs to build the conviction for you. You have the insights to do so. You're getting your LP updates. You can talk to those founders directly. And I encourage everyone that wears an LP hat to do so.
Any other advice for allocators given the climate today?
It's tough. I talk to a lot of my seniors, and, they tell me that this is the toughest environment in the past 15 to 20 years. But I think raw talent is abundant in both the manager space and the founder space. And don't shy away from what you want to do. There's a reason you have this thesis. You have to persevere, whether you got to augment your fund size to get up and running. Don't let it be a deterrent. Yeah, I mean, it's tough. On that side, it's tough. Capital is getting increasingly more competitive. Efficiencies on the allocator side are like just rapidly improving, especially with all the tools you can leverage for crunching big data and analytics that help make decisions faster. I think you're going to have to differentiate yourself, whether it's strategy based, whether it's methodology based, process based, experience based of the team of the GPs. I think you gotta be able to articulate just why you're gonna win, what you do best, and you have to prove also that you can maintain that discipline to execute on what your thesis is. And I think that's going to be a big thing, is that you'll get a lot of people that move with the markets to kind of, especially if you're fundraising. And I don't think that's the right approach, because it shows a lack of conviction in what you came to the table with. So I think if you're building conviction around something, pursue it, be hell-bent on pursuing it. Ignore the noise, show that you can execute your strat. If there's certain LPs that are coming to you now and it's not the right time, just prove them that it should have been the right time when you go out for fund 2 or fund 3.
What do you think allocators, it seems like the tides are definitely the tides are changing, right? In the venture asset class. And a lot of people will be going to market in 24 and 25. How should LPs manage this process? How should they take advantage of it as well? You gave some great advice for the GPs just now, but
for sure.
Yeah.
On the LP side, I think there's a lot of different types of LPs, and if you're looking at established managers, it's a lot different, the lens you're looking through, than if you're looking at emerging managers, and you need to have sensibilities around the differences in them. I also think you need to be very aware of the actual asset class itself. If you're a new LP to VC, most likely you haven't held something that's basically illiquid for 8 to 12 years. It's not that common that you hold assets that are that illiquid. I mean, even hard assets are relatively liquid. So I think that's another thing, is understanding that this is a long-term asset class, and your idea of, you may see managers producing meaningful DPI in year 6. You may see ones producing meaningful DPI in year 8. You may see ones producing meaningful DPI in year 10. And I think that it's an absolute value game, whether the DPI comes year 6, year 8, year 10, or year 11, even year 12. Performance is performance, and I'm looking for absolute performance, as I think a lot of other LPs are. And it's getting them comfortable with these types of dynamics. Even the way you evaluate managers, like a lot of LPs are not comfortable emerging manager investing because they feel like there's lack of track record, there's angel track record, there's a lot of variables that go into it, and you're more closely underwriting an emerging manager to the way you'd underwrite a pre-seed investment, especially if it's things like fund 1s, where obviously there's a set of qualitative data. I don't think there's any manager going out to raise with no track record. That being said, you're underwriting heuristics a lot, you're underwriting intangibles, you're underwriting the inherent drive. Another thing with emerging managers that are quite interesting is the intrinsic motivations to perform are a lot higher. There's way less complacency in where they are. If they don't perform, they don't raise a fund 2. And I think being able to spot characteristics in managers that speak to that ability to persevere and work just relentlessly hard to perform for their LPs is extremely important. And I think new entrants to the asset class will have a hard time underwriting for things like that versus someone that may be on a fund 5+.
Where do you think, with all those trends, what are your predictions, kind of like with the macro venture asset class overall?
Yeah.
More funds, less funds?
I think there's an ebb and flow. I don't think we're at a place yet where we've seen the full effects of the macro shift yet. I think we will see a lot of this start to manifest in 24. But I kind of parallel it to like restaurants in New York. When one closes, another one pops up the next day. I don't think there's going to be any shortage of new managers popping up. I don't think there's going to be any shortage of new great managers popping up either. And I even think on the entrepreneur side, a lot of these guys at the earliest stages, they're looking for someone that understands their business and wants to be on this cap table and help. And I think that especially non-lead or co-lead emerging managers have an advantage to being able to work their way and hustle their way onto some of the best cap tables.
Just sort of top level, when you think about the future of venture capital, what comes to mind?
Yeah, there's a lot of things I see. I see liquidity becoming more abundant, contrary to popular belief. There's a lot of different mechanisms for liquidity to be generated that are being built right now. VC is getting more and more democratized. You see it with a lot of these platform plays. You see it with the difference in 501Bs, 501Cs, the ability for non-accredited people to participate in these things, crowdfunding, DAOs, platforms where you can buy secondaries as an accredited investor. And there's quite a lot of activity on them. You even see a derivatives market for VC showing up as well that has traction. So I think there's a lot of things going on right now. You have regulatory landscape changing, which may deter new managers as compliance becomes heavier, as you're going to have to offer more transparency. The macro obviously has an effect when there's less of an abundance of capital. Capital becomes increasingly more competitive. If you follow the money, you'll see that it goes back towards very established managers during those periods. Yet conversely, the emerging managers tend to outperform in those same periods if you look at historical data. So I think there's just a lot of evolution occurring in the asset class. It's becoming way more mainstream than it ever has been. I also think the globalization of VC is still only at like some of its earliest stages. I think emerging markets are going to become increasingly more interesting on the private side. It's been a narrative for a while. They've had also deterrence on liquidity side because the United States obviously has the most robust capital markets and liquidity environments. But you're in a globalized world that doesn't have a linear trajectory, and markets are going to market, and they're going to need to find ways to support local businesses. They're going to need to find ways to grow their GDP, and that's going to start at a local level.
Are you seeing more U.S. managers investing internationally, international markets, or also considering, taking meetings with some of those folks who are based in these markets?
Yeah, I have. I've seen U.S. managers start exploring, a lot more international markets. They're still predominantly U.S. investors because I think a lot of people, especially in this industry, know that without that local context, it's quite hard to be successful solely in a foreign market if you don't have that. That being said, a lot of people do have boots on the ground in the markets that they do deploy into, even if they're US-based firms. And I do think you'll see an increase of opportunistic buckets carved out that do tackle other parts of the world outside of their core geography.
Any parting thoughts for our audience of other allocators and emerging managers?
Look, I think that we're in a very interesting time right now for venture. I think it's one of the best times to be an allocator, to be an investor, to be a LP. I think it's a tough time to be a GP, an entrepreneur, but I think that if you can survive in this market, that it's going to be a big testament to what you're building and that people can get behind you and want to back you in this environment. And I think no matter how small the win is on that side, you should celebrate it because you're in a period that just, we've been numb to it for the past 12 plus years in terms of that being the macro. So I think that any small win in this environment, you should celebrate and you should be proud of yourself and you should just keep tackling it with absolute perseverance.
I love that. Gratitude, gratefulness,
conviction,
and acknowledging that success.
For sure. It's important.
Sam, thanks again for joining us today on Swimming with Allocators. Appreciate you.
Appreciate you guys.
See you later, alligator.
After Portfolio Tile, Investing with a Smile.